90% of Forex traders fail. You've probably heard that statistic thrown around, and it's terrifyingly true. But what does fail actually mean? It means they quit, usually after blowing up 1, 2, or even more trading accounts, losing thousands of dollars and countless hours of effort. And it's not because they can't read charts. Many of these traders are smart, dedicated people who spend months, even years, learning technical analysis, memorizing candlestick patterns, and mastering indicators. They can spot a head and shoulders pattern from a mile away. It's because they have zero risk management. They fundamentally misunderstand the game they're playing. They think trading is about being right and predicting the future, but the professionals know the truth. Trading isn't about prediction, it's about managing uncertainty. Today I'm going to give you the real truth about protecting your capital, the single most important skill in trading. This isn't just a tip or a trick, it's the exact system that's kept professional traders profitable for years, through bull markets, bear markets, and everything in between. By the end of this video, you'll know how to protect every dollar you trade, and why this is the only thing standing between you and blowing your account. You might have the best trading strategy in the world, one that wins 70% or even 80% of the time, but if you risk too much on a single trade, one bad day, one unexpected news event, one black swan, can erase months of hard-earned progress in minutes. This is why successful traders focus less on being right all the time, and more on protecting their capital. They treat their trading account like a business, and the number one rule of business is, don't go bankrupt. Think about it with this brutal math. If you lose 50% of your account, you need a 100% gain just to break even. You have to double your money just to get back to zero. The math gets even worse from there. A 75% loss requires a 300% gain to recover. That's why most traders never recover after a big loss. The psychological and financial hole is just too deep to climb out of. Now let's talk about the most important rule in risk management, the bedrock of any successful trading career, the 1% rule. It's beautifully simple. You never risk more than 1% of your total account balance on any single trade. Some professionals might go to 2%, but for 99% of traders, especially those starting out, 1% is the golden standard. If you have a $1,000 account, your maximum acceptable loss on any one trade is just $10. If you have a $10,000 account, your max loss is $100 per trade. No exceptions, no negotiations. This rule automatically forces you to size your positions correctly. Let's walk through a real-world example. Say you have a $5,000 account. Your 1% risk is $50. You see a great setup on EUR/USD and your analysis says your stop loss should be 25 pips away. You simply divide your dollar risk by your pip risk. $50 divided by 25 pips is $2 per pip. This means you trade 0.2 lots. Your risk is now mathematically fixed. This forces you to set realistic stop losses based on market structure, not hope. And it forces you to think long-term. Even if you hit a brutal losing streak of 10 trades in a row, you've only lost 10% of your account. It stings, but it's a recoverable flesh wound, not a fatal blow. Your account stays alive. The goal isn't to win every trade or make a fortune overnight. The goal is to stay in the game long enough for your statistical edge to play out over hundreds of trades. Here's the truth that most gurus won't tell you. Risk management is less about numbers and spreadsheets, and more about managing your own destructive emotions. Without a hard rule in place, traders inevitably fall victim to their own psychology. After a winning streak, they feel invincible, high on dopamine. They think they've cracked the code and start to over-leverage, thinking they're invincible. They abandon the very rules that made them successful, or even more dangerously, they double down after losses. This is revenge trading, a desperate, emotional attempt to make it back fast. You feel the market has personally wronged you, and you're going to get your money back on the very next trade. Both paths, euphoria and revenge, lead to the exact same destination: disaster. The 1% rule is your psychological circuit breaker. It removes that emotional pressure. You know exactly how much you stand to lose before you even enter a trade. The decision is made when you are calm and rational, not in the heat of the moment. And that peace of mind is priceless. It lets you trade logically, not emotionally, and focus on executing your strategy flawlessly. But risk management isn't just about how much you risk, it's also about how much you aim to make. This is the other half of the equation. This is where the risk-to-reward ratio comes in. It compares the amount of money you're risking to the potential profit you're targeting. For example, if you risk $10 on a trade with the potential to make $20, that's a 1-to-2 risk-to-reward ratio. Professionals almost never take a trade unless the potential reward is at least twice the risk. With a positive risk-to-reward ratio, you could lose more trades than you win and still end up consistently profitable. For example, with a 1-to-3 ratio, you risk $100 to make $300. You could win just 3 out of 10 trades and still be profitable. 3 wins gets you $900. 7 losses cost you $700. You're still up $200, even with a 30% win rate. This is why pro traders care more about the math of their system's expectancy than their win rate. A high win rate feels good, but a positive risk-to-reward ratio pays the bills. But here's where most beginners slip up, even if they know the rules. They fall into a few classic traps. Don't do this. I'm serious. Write these down. First, over-leveraging. Using borrowed money to trade huge lot sizes, chasing those lottery ticket wins. It's like driving a Formula One car in a parking lot. One tiny mistake and it's game over. Second, ignoring or moving your stop loss. This is hope as a strategy. You're no longer trading a plan, you're praying. A stop loss is a non-negotiable business expense. Pay it and move on. Third, risking more after a loss. This is pure revenge trading. You're emotionally compromised and trying to force the market to give you your money back. The market will always win that fight. And fourth, trading without a plan. This means you have no predefined entry, exit, or risk parameters. You're just gambling and the house always wins. Every single blown account in history can be traced back to one of these 4 mistakes. Avoid them with religious discipline, and you're already ahead of 90% of other traders. So, how do you actually apply all of this in real life starting today? It's a simple 4-step process. Step 1. Decide your risk per trade before you even open your charts. Commit to 1% or less. Write it on a sticky note and put it on your monitor. Step 2. Before every single trade, calculate your exact lot size based on your stop-loss distance. Use a free online position size calculator. No more guessing. Step 3. Only take trades that offer a favorable risk-to-reward ratio, ideally 1-to-2 or better. If the setup doesn't offer it, have the discipline to walk away. Another trade will always come along. Step 4. Journal every single trade. Don't just record the numbers. Write down why you took the trade and how you felt. This journal will become your most valuable mentor, revealing the patterns in your behavior that lead to profit or loss. The best traders don't think in terms of a single trade, a single day, or a single week. They think in terms of the next 100 trades. They see trading as a game of probabilities, and they know their edge will only materialize over a large sample size. Proper risk management is the system that ensures you'll survive all 100 of those trades, no matter how many inevitable losses you take along the way. The truth about risk management is simple. It's not sexy, it's not exciting, and it won't give you a dopamine rush. It's the boring, disciplined, process-driven side of trading. But it's the only reason successful traders stay profitable for years, building real life-changing wealth, while the gamblers and thrill-seekers quit within months, their dreams and their accounts shattered. Master this, and you've already won half the battle in Forex. You've built the foundation upon which a long and profitable trading career can be built. If you found this helpful, and you're ready to treat trading like a business, subscribe and watch my next video, where I'll reveal the top 3 trading mistakes that kill even the best strategies.